Good evening, everyone. Welcome to Admiral Markets. Thanks for joining us in today's webinar on Thursday, the usual Pro Learning Lab webinar that we have on these Thursdays. We're going to take a look at Keltner, Bollinger and Envelope. It's a strategy webinar today. So Nanette is with me today, and we'll be both looking at this topic. Personally, I have prepared material regarding Bollinger. So that will be Keltner and Envelope. Most likely, Nanette will then discuss later in the second section, let's say, of this webinar. So looking forward to that. Alrighty. So with that said, we have still some stuff to discuss regarding, for instance, this disclaimer explaining that the webinar today is intended for a global audience. Please take into account that the info in this session may not be suitable for everyone. To get the corresponding information on charting, conditions, and other details, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, trading for exchange and global financial markets and products is considered high risk and may not be suitable for all investors. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with the content mentioned here, and we do thank you for your attention. Alrighty, so we can move on and take a look at today's lesson, basically, or webinar. Let me say it this way. So it's basically, I'm not sure if I have. Yes. Okay. Good. Sorry, I was doubting for a second there. No, it's the correct slide. So basically, the strategy that I will be presenting here in today's session is a trending strategy. It is a breakout, basically. It is also a swing strategy. It's a 4-hour strategy, in fact. It is technical analysis, basically, and I would say the level of discretion is quite low. So I think it does meet what many traders are kind of looking for. I think that it never can hurt to have a strategy that is less discretionary. So that's always an advantage, of course. Basically, the fact that technical analysis is almost logical, obviously, almost logical in the way you know how I trade. For those that are in the trading room, it's actually a strategy that I've already explained in the Forex strategy room, but only briefly, so I don't think it could hurt to go through it again. And some of you have never been in the Forex strategy room those particular 2 times, so maybe you don't know it. Then the string strategy, basically, it's a 4-hour chart, so it is tradable for most people, unless you have a very strict boss that doesn't allow you to look at every 4 hours, let's say once or twice within the day at the charts, but otherwise it should be doable. And it's a trending one because, well, I think it's the biggest R2R there in general. So what tools and indicators are used? The Tenkan Sen, the Kiyun Sen, those are both from the Ichimoku, and the rest of the Ichimoku is deleted. So I don't use the Chenkin, no, what is it called? I always forget them. The Kumo Cloud, obviously, the Chenkin Span, I think it is. Nah, I'm saying it wrong, but the other 3 elements are removed. Parabolic, 2 values, 2 and 5, 2 parabolics with 2 different values. Parent Bollinger Bands, actually, why I have it in parentheses is because I did the original testing without it, but you can use it as optimizer, and candles. Candlesticks, I mean. So we're going to use this module. This is a checklist prior to entry for those that are joining the live trading room, lab, or webinar, I should say, sorry. Know this module. Basically, it's a checklist that we can go through one by one to basically determine if the currency is indeed meeting our specific requirements that we have for that strategy. So, for instance, strategy 1 that we're looking, let's say we're looking for a certain strategy, right? The market, we're looking for a trending market. Let's say the market is trending, so check. We can go to step 2. We're getting a candlestick pattern, some at resistance, so check. We got another go, we can go. If no filters in play, check. We can move on to the next checklist. Trigger is in play, check. Then we decide entry method. The price goes there, check. So 5 checks, entry, right? Any of these no, that basically means no entry, right? At that point, at least. Maybe later on, the entry could still occur, or maybe the currency pair is totally taken away of the interest list for that day. That depends, but these 5 steps basically are what I'm looking for. So the trend, let's talk about that, is done on the 4-hour chart. Uptrend when Tenkin is above Kiyun, downtrend when Kiyun is below Tenkin. So let me show you an example on the chart that's better. But basically, at all times, there is a trend. That's the funny thing about this. There's really no range environment. Of course, we know that there's always some kind of range environment, but later steps, later other parts of the module are basically removing the disadvantage that this could have. So basically, in this strategy, there's always, it's black and white. It's either up, it's either down. There's no other way. We always automatically go actually to the second step. There's no setup is filtered in the first step. There's always an answer here. Whereas other strategies I have, there's not always that clear. The first step, the trend, might mean that certain currency pairs are definitely crossed out because they don't meet what I'm looking for. In this specific strategy, that doesn't happen. There's always an answer for this particular step. So let me show you an example. Let me go to my charts, and I had an example ready on the Euro. I just have to scroll there 1 second. It's prepared. It's just on the other side of the template. Right. Here it is. So basically, Euro-AUD is a good trending pair. I think that would be. I think this strategy would be good for it. The strategy I tested it on. The pair I tested it on was Euro-AUD, by the way, but I think it would be good for Pound-AUD, Euro-Yen, Pound-Yen as well. I'm not too sure about the Kiwi dollar, dollar-CAD, dollar-Swissy. Those are less volatile pairs. I really don't know how good the statistics would be for those, though. I think it would be better for pairs that move faster and further. So that's a bit of a warning in advance. So what is the Kiyun and what is the Tenkin? In this case, the Tenkin is the pink one. The Kiyun is this dark red one. The Tenkin is faster. The Kiyun is slower. So if the Tenkin is above the Kiyun, that's an uptrend. If the Tenkin is below the Kiyun, that's a downtrend. Why? Because the faster is moving along with the price closer. So obviously, if the faster one is below, downtrend. If the faster one is above, uptrend. I think that's very straightforward. I wouldn't expect any difficulties, but maybe some of you are new to trading in general, and this is one of your first webinars, or you want to get more clarification on that, let me know. Please just ask a question in the chat box, and I'll get back to you. But otherwise, I'll assume that this is clear. So in this case, let me mark the lines. As soon as price crosses here, it's uptrend. The Tenkin crosses the Kiyun, it's uptrend. And as soon as Kiyun crosses below, back below, which happens actually here, it's a downtrend again. Then we get a cross again here, it's an uptrend. Actually, there are cases, very rare cases, when the Tenkin and Kiyun are equal. Well, that would actually then be no trend. But it happens so little and so infrequent that I don't think it's really something that will happen too often. But that theoretically could happen. So from this line onwards, uptrend. So let me continue. Opportunity. Opportunity is when Tenkin has an angle. So if it's flat, there's no opportunity. There's no momentum. Therefore, there's nothing to do with that particular pair. If there is an upward angle, we're looking to trade it only in the uptrend. So we're looking for uptrend and up angle, or downtrend and down angle. Let me show you. Here, for instance, we have an up angle. In this part, that's good. So anywhere between here and here, basically, let me make those maybe a bit different colors so it's clear. Those orange lines, that not only is an uptrend according to our trend definition, but it is also an opportunity because the Tenkan has the angle in the same direction as the trend. So this part here where I'm pointing at is flat, isn't it? That would not be an opportunity. So we would skip that part. Here it's down. That too, it is an angle, but it's the opposite angle of the trend. It's an uptrend and there's a downward angle. Does that make sense? The idea is, I hope I'm clear. I hope it's interesting. The idea is that you're basically looking for a trend and the momentum to be on the same side. So where the Tenkan and the Kiun are pointed in the same direction, and the Tenkan is above the Kiun and the Tenkan is pointed to the upside, that is the opportunity with the trend. Filters. That could be anything. For instance, I really actually didn't use filters with the statistics you will see later on connected to the strategy. So the filters could hopefully make the strategy even better. I didn't look at any filters when testing the strategy. So that is maybe good, but it could even be better than maybe with these filters. But filters you could think of in theory are, for instance, there's one I did use, by the way. Sorry. The one I did use is the candle shouldn't be closing too far from the high or low. When the breakout candle cannot be cannot have a big wick. Then I didn't take it. The other things that I want to show could be optimizing the strategy is basically the Bollinger Band with the close above it, or if the wick is hitting the Bollinger Band. And big daily tops or bottoms, for instance, on the weekly or daily chart could be something to be aware of. So how about the trigger? When would a trader potentially get interested in trading this strategy? What is the trigger? When the first three conditions have green light, then I'm looking for price to go through the parabolic. So basically, let's see if we can find an example. This actually is not a good example. Let me see. Here. This is an example. And I'll tell you why. Write that candle there. And the reason why is because basically the Tenkan, first of all, is above the Kiun, which means uptrend. Furthermore, when the candle broke, when the candle broke above these parabolic, the Tenkan had an angle. You can see here, this candle has an angle on the Tenkan. Check. Third step, filters. The close was near the high. That means the bulls were in control. If you can't see it, I'll take off this horizontal line. Look at that. The close very near the high. The bulls are in control. Check. Step 4, the candle is breaking through one of the two parabolics, actually both. All we need is one of the two. So the entry then, that's the next step. This is the trigger basically. The entry is simple. It's the candle close. It's the immediate candle close. So the entry is at that purple line. It's that simple. So that's an entry. Trade management things. Well, I should actually, before that, I should talk about the stop loss, in fact. Stop loss would be below the bottom there, just a few pips below that. That's the stop loss. That's logical, but one could even use, if it's a really big candle like that, maybe the candle close, but that's not what I tested. But from a discretionary point of view, we can see this is a power bar. This is a very strong, powerful bullish candle, so that low is probably well guarded. I mean, not guarded, but has a high statistic of being used. So, but not being broken, excuse me. But technically speaking, this would be the stop loss. The trade management side of things is now, and for those, I see a couple of people leaving. I don't know why, because I thought traders would like strategies, but if you're specifically in here for Keltner or envelopes, I would just ask you to be a bit more patient, and Nenad will have something on that soon, okay? So, trade management. One of the exits is parabolic 2, when price hits parabolic 2. So that is, the parabolic 2 is this light blue one, all right? So the exit, when price hits it, is this doji here. I'll put a line there, right there. That's the exit. Price hits it. Not only that, but the parabolic goes to the opposite side. That's what we're waiting for. So when that happens, an immediate exit upon the close of that candle happens right there. All right, so that would be the exit at, let me make it magenta. All right, that's the first exit, potential exit. The second potential exit would be the Tenkin. Tenkin recrosses Kiyun to the opposite direction, but price also closes on the opposite side of the Tenkin. When does that happen? Well, let's take a look. You can see Tenkin and Kiyun are crossing here, and the close is below the Tenkin. So the second close would be right here. That's where the second entry close would be. Second exit, excuse me. So it's not a great trade in this case. The parabolic did a bit better. Usually the Tenkin exit on average gives a bit better. Across a long-term approach, the Tenkin does, but the parabolic sometimes catches a bit more profit if the market doesn't move that a lot. In this case, basically, the market continued our way, but really didn't give much of a run. It's a very short movement. In fact, it only moved about 170 pips with us, which is not really a lot on the 4-hour chart. So it was a very short movement. Considering that fact, I'm not surprised that the parabolic gave a better result than the Tenkin, because the Tenkin is giving more space to the trade to develop. So when the Euro goes for a big run, for instance, then the Tenkin would do a better job than the parabolic, because then the parabolic would have a worse result. When there's a short run, then the parabolic usually gives a better result. So it smooths the equity curve a bit when you use both of them. In this case, which I said is a short run, basically the Tenkin gave plus 14, the parabolic gave 100 pips versus 160, which basically on average will provide about 0.4% return on this trade if you risk 1%. So it's not a fantastic result, but this is an average, not an even average, but just one of those trades that doesn't go all too far. That happens. Let's see if we can find more examples maybe. This one right in here, it does not count. And why is that? Because when the Tenkin is above the Kiyun, so you are in an uptrend, yes, but the Tenkin is flat when the candle closes. So there's no momentum. So that's one thing. Plus, there's a big wick when breaking through the parabolic. So that one is crossed out. Although actually, to be very honest, it didn't do that bad. It still moved up forward and higher. So before I give you more examples, let me show you some statistics. The Euro odd basically gave us 50% winners, 50% losses. The parabolic exit gave about plus 0.39 per trade. The Tenkin exit plus 1.25. If you average that out, you got about 0.82 average per trade. Those are good results. I'm not going to lie. Those are very good. Those actually are almost too good in the sense that you shouldn't necessarily maybe expect that for all currencies, because you would have too high expectations probably. So yeah, this was very good. It was more data would be needed, by the way, because it was, I think, 1.5 years, so it's not a tremendous amount. Could be more, but it gave good results. The average win was plus 3.2. The average loss was minus 0.58, which means if you divide those two, the profit factor is 5.55. With more than 50%, with about 50% trades ending up plus 1 or more. Excuse me, more than that, it's close to 60. So 60% of the winning trades had a return of 1 or more, and only a quarter of the trades had a full loss. That's a tremendous ratio. That means that basically twice as many trades went close for plus 1 or more, whereas if you limit your risk to minus 1%, you only in 25% of the losses, 25% of the cases, when you have a loss, it's a full loss. That's a 2-to-1 ratio. That's really very powerful. It's really, really good. Yeah, it's very high statistics, and that's why I want to guard you for getting too excited, because it could be just very good statistics for that pair, maybe a bit better on that particular time frame, part of the 1.5. I mean, these 1.5 years. So I personally think that the average will water down if you take a bigger sample. Maybe I don't think the sample is bad. I just think that the stats are on the high side, and I think they will get a bit lower if more pairs are taken into consideration. So just to not to get you too excited, but I mean the stats are phenomenal. The T statistic, which is showing basically the expectation, how stable is the strategy? Is it just lucky that there's profit, or is there actually a sustainability behind it? Well, that had 2.7, and basically when you get 2 or higher, you're in that stable zone. It was way above the stable zone. Actually, could even go up to 4 if you, depending on how you exit. So it was really high. Sorry, it's not the end of the webinar. I just wanted to show you statistics. So now that I maybe have piqued your interest a bit more in the strategy, let's show you a few examples. I don't know. Let's scroll back to each. I mean, don't want to show you something specific. I don't want to show you something that I chose, so I'm just closing my eyes and we will see. Obviously, the trend environment is better. When you have a trend environment, this is going to do better. So, I'll give you one trending environment example. Then otherwise, you can see here this is moving up a lot. So these are great ones. Take a look here at this one, for instance. Tanking above the Q, tanking at an angle, candle close near the high, breaking through the parabolic. That would be the entry, stop loss below it, and the first exit is here, and the second exit oh wow, I managed to choose a good one I can see, is here. Well, obviously that was a big run. So you can see this was a big one. That second purple line is the second exit, the green one is the entry, and this one is the red one. So this was one of the best trades in that whole series. I can right away add, by the way, just looking at these boxes, I mean this went for 800 pip win, no more. This actually went for 1,000 pips, and the stop loss was 110. So this is about 8-to-1. So this is a very good example, as you can see. Let's scroll back a bit further and see if there are any more choppy environments, because I want to show also the opposite of actually, because I think it actually doesn't do bad with the choppiness as well. Here, this is filtered out because the Tenkan is pointing up, not down. Not an entry there, by the way. So yes, you do have tension below the key-un, but no, the tension is not angled down. So this example right there is not 1. All right. Let me show you. Let's see. Here's nothing special, I would say. Here's a tension above key-un, tension angled, breakthrough parabolic, close near the high. There's the entry, stop loss either here or a bit lower even. Where would the exit be? One exit would be here, and the other exit would be when the tension crosses the key-un, but also price closes below the tension, which basically means, it's funny, it never happened here in fact. That's really funny. It's actually all the way here, right at break even again. Right there, this candle. That's where the tension closed below the key-un, and also the candle closed below the tension. So that was one part break even. One was about 0.8 to 1, probably 0.8%. So that is one where you get a break and you go into a big consolidation, and still doesn't do too bad. Let me find the loss. How does a loss look like? This is a loss. This could be a loss because depending on the exact calculations of the candle wick. I think I was looking for 50% or more, so I'm not sure if this one was filtered out. Let me take a look. The high and the low difference is, yikes, it's only 25 pips. It's a very small candle somehow. So the candle wick was about 40%. So I don't know if I took this one or not. But it's a doubtful one. It's a small candle. But anyhow, if it was taken, it would have been a loss because it went through the top here. Let's see. This one is filtered out. A wick. Oh, the pink line was flat? Oh, thank you. Let's see if, yeah, sorry, you're right. Yeah, the pink line was flat, so that would be filtered out. I skipped my own step indeed. Let's see. Ironically enough, quite a lot of things get filtered out. On average, there were about 3 trades a month, so not a lot. But if you are able to add more pairs, then of course it would be a bit more opportunity as well. Let's see. This is a big wick, so that wouldn't count. This is a big breakout candle. That probably closes for a small win and break even, as you can see. Maybe this one here. That looks like a loss because it's a breakout candle that doesn't get any follow through and just crashes. So that looks like a loss. That sometimes happens, as we can see. Right? So this would be a full loss because price breaks through it. We got the angle. We got the trend. We have a close near the high, and it just, despite the fact that the close is near the high, boom, falls without any warning. So yeah, that would be, actually the break, to be honest, the break was earlier. Sorry, it was not that candle. It was this one. Okay, so that's a bad example, actually. It's stupid. But I mean, anyhow, believe me, there will be examples where price just doesn't get the continuation like that and then falls. You know, that it's not perfect, obviously. Now, I'm running a bit out of time here, so I guess I don't really have much time to discuss the Bollinger Bands. Sorry about that. But the idea would be that if price is, once again, let me show you. Where is it? Here. If the candle is closed above the Bollinger Band, or if the wick is hitting, a big wick is hitting the Bollinger Band, we could use it to further optimize maybe the strategy. Now I'm using confusing colors, so let me make this orange. And let's take a look at some quick examples maybe. It won't filter out everything, obviously. But it could be a refined tool to be careful of potential breakouts, maybe. Let's see. You see here the closes are not above the Bollinger Band, so that is okay. Let me see if I can find an example here, for instance, but this one we already filtered out because of the wick. But we see also the Bollinger Band flat, and here we see the Bollinger Band getting angle, so that's a bit different. It could be a good confirmation tool of certain developments. Let's see. Sorry if I'm going a bit fast here. Okay, well, I guess we're running out of time. So this is basically it. The main strategy is not Bollinger, but I think it could be useful to look at it in combination with these ideas to see if it could be further optimized, maybe for certain pairs like the Kiwi, for instance, that are not as fast movers as is euro-dollar. I will now hand over the presentation to our friend Nennet, and I'm sure that he's going to show some interesting stuff regarding Keltners.
Sure, thanks, C. Great presentation by you. So yeah, Keltner Bands. I will also tell a few things about Bollinger Bands, and then I will present strategy for Keltner Bands. So let's talk about a little bit about Bollinger, then Keltner Bands, some few things about envelopes, and then I will present you a free strategy that is based on Keltner Bands. It's a scalping strategy. About Bollinger Bands are one of most useful indicators in Forex world. And basically, when John Bollinger make a presentation, an inception of Bollinger Bands, it was a breakthrough in the world of Forex trading. And Bollinger Bands are really used for trend trading, and most obvious use for Bollinger Bands is counter trade trading, because those lines can identify tops and bottoms very, very precisely. And especially when you're doing confluence with other indicators such as pivot points or important support and resistance lines. I think about also to present one more strategy about Bollinger Bands in one of our next webinars during maybe August or September, and that is pretty, that was, at least as far as I know, very successful back in the year of 2009 and 10 on Forex Factory Thread. So I may present it. Important thing to say about Bollinger Bands is that they're consisting of a center line and two price channels below and above it. The center line or section is usually EMA, or exponential moving average, and the price channels are standard deviations of the Forex pair which we are observing. Markets are usually very unstable if we trade it on daily basis, and as you know, we are practicing to be masters of intraday trading. And for me, I don't have any problem with analysis and taking trades on intraday basis. But back in time, before John Bollinger developed Bollinger Bands, it was a very uncommon occasion that day trading was so prominent and successful. Mostly traders were trading like swing traders. They were trading swings up and downs intra-week or intra-month. And day trading was purely reserved for some scalpers, and day traders were not taken seriously. Well, with the expansion of Forex retail trading and MetaTrader 4 platform generally, Bollinger Bands got into the center section because they are really, really useful for day trading. And we need to say that Bollinger Bands can also give us a sign of volatility. And the market can either be in uptrend or downtrend or ranging. We basically, technical traders, we use moving averages with support and resistance lines to determine the price action of a Forex pair. Upper resistance and lower support lines are first drawn, and then they are extrapolated to form channels within those channels that traders expect prices to be contained. So we use Bollinger Bands in conjunction with price action patterns and with different pivot points. Now, this is the formula. I don't need to read the formula. You can see it on the screen. This is the formula for Bollinger Bands. And the most important thing, as I am concerned, is that Bollinger doing great job in identifying tops and identifying bottoms. When Forex pair goes or touch the upper Bollinger Band, then the prices are usually overbought, and we can expect some pullback to the middle line or to exact Fibonacci ratio. Oppositely, when they touch the lower band, prices are usually oversold, and that is a buy signal. Usually we take that as a retracement. So very good thing to complement Bollinger Band is trading Bollinger Band with MACD divergence. That is a great thing to do. And that is purely counter-trend strategy. That doesn't have anything to do with the trend. Moreover, Bollinger Bands can also be traded as trend indicator, supplementing trend Forex trending strategies. I'm not particularly fond of trading Bollinger Bands as a trend as a trend indicator, because so far from my experience they are quite good for determining turning points, even for scalp or scalp swings, especially on when ATR is more than 100%. If you want to trade this or Bollinger Bands as a trend, then we call it riding the bands. That is the common form because it's easier. Back in time, some traders thought that when Bollinger Bands are going sideways, that is called Bollinger Band squeeze. And when Bollinger Bands diverge one from another, that is usually a start of the trend. And when bands are continuously broken through and rode through, then it's basically a pure trend. I don't recommend that kind of trading today because there will be many fake outs, and riding the bands on Bollinger is, that means that you would usually buy when the price is already a little bit high. Remember, we want to buy into support as close, and we want to sell into resistance as close as it can be. Riding Bollinger Bands like trend trades, my opinion, I don't recommend it. Bollinger Band without middle band is indicator which is called bands. That indicator can be found on the internet. It's called bands, and it's very useful for strategies which use Bollinger Bands, but you don't need that middle line. So you can look for an indicator called bands. Once you open the indicator, you can put the color to none, and the middle line will be gone. So that is something about Bollinger Bands. And look now, look at this chart. This is, doesn't matter, 4-hour time frame. Usually we think that when there is a break of Bollinger Band to the upper side, which is followed by the intermittent close below the band, the price will retrace. And that is the truth. Look at this. Look all of those examples. This is a break from Bollinger Bands and subsequent close. Then look at the price went down. Same here. I will mark it up. This is the example, this is the example, this is the example for buy trades, for short trades. Once the Bollinger price breaks through Bollinger Band, upper Bollinger Band, and next candle closes into the Bollinger Band, we think that the price will indeed go down because it was rejected from important resistance. These three examples are showing you that. Next example is the opposite. Break below, then close inside. This was the break below the Bollinger Bands and close inside Bollinger Band, which was a signal to a long trade. Same here. Up and inside the Bollinger. Up and inside the Bollinger. Look at this. If you follow this, the only loss you would suffer is here. This is a loss on this example. 1, 2, 3, 4, 5, 6 winners versus one loss just following that simple rule. Now, as you know, Forex is not that simple, and we usually want to find important, good strategies which can use this rule. Stop loss, Claudio, for this kind of trading is always above or below previous swing high or low. So if you traded here, your stop would be here. If you traded here, your stop would be there. If you traded this, your stop would be here. If you traded this, your stop would be here. So, you know, it's 4-hour time frame. There are not much whipsaws on the chart, but you need to know that if you're trading and base your entries on 4-hour time frame, then you need to have a big margin. You need to use wider stop loss. So, you know, it's not uncommon for 10,000 account to be traded with 0.1 on 4-hour time frame if you use 4-hour time frame. Okay? But use this because we will have a webinar in August, how to create your own system. Remember, I was talking about it yesterday. I will tell you what you should take into account when you want to create your own method system. And this is one of great rules which you can incorporate in your own trading method. Bollinger Bands, break, then close inside are a basics of Bollinger teachings. Okay? So use that rule and use it to your advantage. Now, let's resume this and sum it up. They work in conjunction with pivot points and other support resistance indicators. It's primary support resistance indicator. It's used for riding the trend, but I don't recommend it, okay? I don't recommend it. This is what I recommend. Counter trend setups by Bollinger Band are most frequent, and you should concentrate on that. Squeeze. This is called the squeeze. This is Bollinger Band squeeze, and you can see after the squeeze, you see this is the squeeze. Once Bollinger Bands start to diverge, then there is usually start of the trend. This is a false start of the trend. We had only one swing here. And then you can conversely see the next swing. So I don't like to ride the bands, because many times your bands would look like this. So this is what I am paying attention to always. If I would trade Bollinger Bands, this is one of the rules I like the most. Okay? Now, what are Keltner channels? Keltner channels are volatility-based envelopes. So they are based on envelopes. They are volatility-based envelopes which are set above and below an EMA. We can say that Keltner channels are very similar to Bollinger Bands, but they use standard deviation to set the bands. So instead of using standard deviation, which is used in Bollinger Bands, Keltner channels use ATR to set channel distance. So what does it mean, translated in English? Keltner channels are primarily trend following indicator, in opposite to Bollinger Bands, which are primarily counter trend indicator. Okay? Now you see the difference. They might look a little bit same, but when we do Keltner trading, we are following the trend. When we do Bollinger trading, we are trading versus trend. It can be used to identify reversals, but usually it's a trend following indicator. Similar to Bollinger Bands, they can be used as overbought and oversold levels, but now this is the same we had with Bollinger. I don't recommend Kelter to be used as a counter trend indicator. Keltner should be used as a trend indicator, and Bollinger Bands should be used as counter trend. Although both of those indicators have both purposes. Kelter can be also used for counter trend and Bollinger for trend. But the better purpose is to filter out it. So when we apply those filters, Kelters are used as trend indicator, Bollinger Bands are used as counter trend indicator. They were introduced, I don't know how much is interesting to you. I can say that Keltner channels are introduced in year, I think, of 1960, and it was Chester Keltner. It was a trader who introduced Keltner channels to stock trading. So if it's interesting to you, we will see a Keltner-based strategy. Chris said it correctly, and in some 5 or 10 minutes, I will show you Keltner-based scalping system, which you can use it. It uses only 2 indicators, so you just need to find Keltner channels and other indicator is integrated on your MT4 platform. So we need to see how it behaves on real-time chart. So you will demonstrate it as always. This is the formula for Keltner channel. So you can see the difference between Keltner formula and Bollinger Band formula is Keltner uses ATR, average true range of the particular forex pair, versus standard deviation, which is used by Bollinger Bands. Now, there are 2 differences between Keltner channel and Bollinger Bands. Besides the difference which I told you, Keltner should be used as trending indicator, Bollinger should be used as counter trend trending. The second difference is already mentioned. Bollinger uses standard deviation and Keltner uses ATR. So Keltner uses an exponential moving average, which is more sensitive than the simple moving average which uses Bollinger Band. Keltner channels are smoother than Bollinger Bands. Okay? But standard deviation has a larger range than average true range. And that is what we come to see. Look at Bollinger, which is green, and look at Kelter, which is black. So standard deviation gives us a wider range. That is good for counter trend. And narrow range is good for trend. Okay? It's a simple explanation of Bollinger versus Keltner. Trend versus counter trend. Standard deviation calculation algorithm versus ATR algorithm incorporated in Kelton channel. We will concentrate now on Kelton channels. Next thing, envelopes. Well, what I can say about envelopes. This is standard MT4 indicator. Envelopes is basically only two moving average. One moving average is shifted upward and another one is shifted downward. Envelopes basically just define upper and lower range. And they basically define upper and lower margins. Signal to sell usually is counter trend, when same as Bollinger Bands. When price protrudes through upper band. Signal to sell is usually below, when price protrudes and trusts lower Bollinger Band. Now guys, if you ask me, I'm more fond to use Keltner and Bollinger than purely envelope. They can work in conjunction with pivot points, and this is the formula. They use SMA. EMA, in my opinion, is better than SMA. At least, you know, on 5-minute Camarilla MACD method, I use EMAs. And I have found that EMAs for scalping are very, they have a lot more, I can say, a lot more usage for scalping than SMA, especially if you scalp on 5-minute time frame, which I do from time to time, not always. Now I'm more oriented towards intraday trading, as you can see on my everyday analysis. You know, when you trade 20-24 pairs, you cannot scalp everything. You need to pick up 1 or 2 pairs, and then it's a little bit time consuming. So, but I can testify that the method which uses, at least that I know of, which uses EMA, is better than which uses SMA on 5-minute time frame. At least what I know of. EMA is basically, you know that it's exponential moving average, and being an exponential, it means it's more sensitive, and that is why Keltner channels might be good also for scalping. And let's see the strategy. This is the envelopes. So blue is resistance, red is support. You can see it's just based on 2 moving averages. I don't see much usage for envelopes. I will try to find maybe a strategy which is and can be useful only which uses envelopes only, but so far I couldn't find it. Now, how this strategy looks like. First, we have Keltner Channels 40 period. Okay, write this down or take a screenshot because you will be using this. You can try to scalp this strategy. Keltner Channels 40 period. So when you open Keltner Channels, you need to set the period to 40. And you just need to put EMA 8, exponential moving average. Long entry, when EMA is greater than upper Keltner channel and price closes above it, we go long. We go short when EMA is lower than lower Keltner channel and price closes below it. Target is 5 to 15 pips. Stop loss is 12 pips. It's done solely on 5-minute time frame. This is how it looks like. Guys, this is how it looks like. This is euro dollar. You can trade every single major pair with this. So you can go scalping 4 majors with this. Euro, dollar, cable, dollar, Swissy, and Aussie. Maybe you can try also with dollar yen. I didn't test. I haven't tested it. But look at the rules. This is long. EMA should be above upper Keltner band, and price should close above EMA and Keltner band. And look, oh, okay, this is, I didn't take this on purpose. I was trying to just screenshot it and look at this. This is really more than expected movement. Now, this is a short which failed as a trade. This is stop loss. This long is again successful. This short is again successful. So, by watching this strategy, and this short is also successful, I recommend you to place stop loss in between 12 and 15 pips and use profit 5 to 15 pips. You can try it. It's simple. And Kelter, this Keltner channel is the most simple strategy I am showing you. But next time I will try to search for Keltner intraday strategy also. This is for scalping purposes. You can see on this example, 1, 2, 3, 4 trades were good, 1 trade was bad. If you use 5 to 15 point stop and only 15 point stops, that should be profitable. But try it, of course. Don't be greedy, try it to see whether it works or not. Okay? So guys, if you have any question, now this is the introduction to Keltner, Bollinger and Envelopes. Next time, I think it will be in August, you will be presented with another Keltner based strategy, which is not so simple. But now, try to concentrate on this to see how Keltner reacts to price and how EMAs filter the trades. Yeah, this is also a successful example. If you go with 5 to 15 pips, this one, you can see break and then. So try to, if you're scalpers, try to use this. Maybe it will be good for you. Okay? It's a simple one. And remember what we talked today. Keltner is used for trend trades. Bollinger is used for counter trend trades. If you have any questions, do not hesitate to ask me. If everything is clear, then we can move on. As always, you should watch our webinars. Today we had a nice short, as I presumed it will be short on euro dollar. And yeah, it was. Unfortunately, the price didn't give us a second chance trade to trade 36.50, but well, it dropped from 36.40 to 35.80. As I presumed, I think maybe tomorrow will be profit taking, which can lead us even lower, but we will see. Pro Learning Lab, of course, me and Chris sign up for next webinar, but the premium webinar is on Sunday. If you haven't signed up yet, go and sign up, because we will be doing hourly and daily pivot point exclusive webinar. I will be giving hourly and daily pivot point indicator. Especially hourly pivot point is second to none. It cannot be found now on the internet freely. Then weekly Forex recap, of course, I will be analyzing 5 pairs. This week was also very good for trading. Gave us a lot of piece, especially on GBP trade, that long from 69.50. and many others. Chris will show you his moving average trading on the 1st of July, and this webinar also is good. Why do traders lose money? Psychology webinar, sign up for that. So you should avoid the trap which most traders fall into, okay? So guys, everything is clear. We can call it a day. So use this strategy, try to find and try to understand how Keltner is reacting to the price. And next time we will talk a little bit more about Keltner Channels. So thank you for attending the webinar and talk to you very, very soon. Cheers!
Thanks everyone. Talk to you soon. Have a great weekend.